Today we're talking trading FX volatility shocks to fade or to follow. How's that title?
I love it. You set this one up perfectly.
Why, thank you. Because we're looking at the background of today, an economic data release in the form of CPI inflation data for June. But this study is, robust enough to to be evergreen in a sense, and not just reliant on this one data release, because right now we're in a low FX volatility environment.
Sure.
But even so, in any volatility environment, when we see something like an economic data release as important, possibly pivotal, as an inflation reading here in the U.S., we can see that volatility play through in U.S. dollar markets more than 3 times the average or more when looking at hourly price data.
And not only is it evergreen for everything that you just said, but also, I mean, we get this data point every month, and we also get PCE inflation every month. And we also have a non-farm employment number every month, and we have FOMC every month and a third. I don't know how you want to take 10 meetings over 12 months in terms of monthly cadence, but essentially you have probably every week a high level. You throw GDP in there, and you've got probably one big U.S. data point per week. But also just this concept is evergreen. Something big in the market happens. Should I be going against that move? If I should be going against that move, and that's what I think you mean by fade, when should I be going against that move? Or should I be following that move? And if I am going to follow that move, where is a good entry point for that? Because, the way that we always measure these things is the industry standard for measuring these things. I don't really know a better way of measuring these things, is some form of volatility or standard deviation metric, which essentially just lets you know, okay, around CPI inflation or any kind of data point or the last 30 days, whatever, what has been the normal activity? And then, to layer on top of that, should I be going with it or against it? And if I'm going to go with it or I'm going to go against it, where is the opportunity? Because obviously, if CPI inflation comes out at 8:30 Eastern time, and then it's 8:33, and these markets have moved, 0.6% in some direction, and I was going to go with it, have I already missed some of the opportunity? Which isn't to say like, oh, now I'm going to fade it, because maybe that's just an efficient move. So I'm excited to dig into this, excited to see what study you cooked up.
Yeah, so just to finish up this background here, the average hourly movement in euro dollar using the past year of data is around 0.06%. That's, coming in every day. But if you look at this graph to the right, you can see I highlighted one of the candles, and the reason I kept a lot of these in percentage moves is because the tastyfx platform calculates it for you right here when you hover over a candle. Here, looking at the hourly chart, and we can see even on a Thursday night with probably the Asian market open, we can see a move of 0.2%,
sure,
which is over 3 times that average. So what we did is we took the last year of price data using hourly close data for major US dollar pairs: euro, pound, yen, Aussie, Canadian dollar, Swiss franc, and New Zealand dollar. And we measured hourly close-to-close moves exceeding some percentage thresholds, so 0.2% all the way up to 0.7%. This, would account for low volatility environments, high volatility environments, keeping it all the same, and simulated trade performance when you enter the start of an hour after a shock move that exceeded one of these thresholds, both contrarian and momentum, so fading the move or trying to follow the move, and also tested exits after different time periods when focusing solely on intraday scalping. So nothing, long-term position trades, but just reacting to a shock move, which strategy wins out, and calculated win rates just based on positive P&L after the given time period. Any questions on my methodology here?
This seems pretty straightforward. The only question I have is, did you at any point do a basic standard deviation calculation of any of these markets? Like, do you know what, like, if VIX at 16% is like the North Star of like average performance, is like 0.2% or 0.3% like a normal hourly move? I know you had the average there.
Yeah.
But what would be like the normal range? Is it under 0.2%?
It would be under 0.2%. This would be roughly 2 to 3 times a normal move in this environment, and then taking into account all the way up to 0.7%. We saw, the range of observations drop drastically by 0.7%. So this kind of aggregates a spectrum of volatility environments.
So then let's create the baseline that like 0.2% is 1 standard deviation, 0.4% is like 2 standard deviations.
Sure.
And then 0.7% is like, okay, now we're, pretty rare air to get close to a percentage point in an hour in an FX market.
Exactly. And it's important to consider for things like economic data releases that this is just hourly close data. It's agnostic of particular releases. This can be used for any move, and a lot of these economic data releases happen on the half hour. So something like this move, where you are getting that, could be within a half hour.
So just filtering for big hourly moves.
Exactly.
Gotcha.
And I know you say I present a lot of numbers to you, way too many numbers, and rest assured, I have them. They're in slides to follow.
I see a lot of numbers, that's for sure.
But first, we wanted to make this as simple as possible. No numbers, just a lot of words. Is that better? And what I did was aggregated, closing positions intraday across those time intervals that I mentioned before, which strategy wins out by magnitude of move. So as you called out, around a 1 standard deviation move, does that change when things really get drastic? And what it shows, and we had a added scrutiny of only if the average win rate was over 50%. So you can see in that New Zealand dollar, for some of those percentage moves, a little too close to 50-50. Wasn't confident giving a signal here, but using the data, past performance obviously not indicative of what can happen.
I want to make this abundantly clear, solely because I like the way that you have simplified this, and I want us to be able to simplify stuff like this in the past. And so I will be abundantly clear in saying that the past performance does not indicate what to do in the future. This is purely telling us, okay, in the last year, if you saw 0.2%, 0.3%, 0.4%, and so on move in these markets, what was the performance on average the next time interval?
Exactly. And which strategy had a higher average win rate?
And so essentially, okay, if that top line there, euro dollar, moved in any given 1 hour bar outside of 0.2% or outside of 0.3% or outside of 0.4%, the last year, on average, the next hour, the market was more likely to revert some of that move than to continue that move. But what's interesting is once you get outside that kind of 2 standard deviation, that big move, you're seeing some of those fades across some of these major pairs turn to follows, which means that if you saw a 0.5% or 0.7% move in that euro dollar market, on average, the next hourly move actually continued in that direction. I'm sure you have the numbers to back all this stuff up, but just right off the bat, you're seeing for euro, for pound, for CAD, and for Aussie, on average, if you saw a 0.2%, a 0.3%, a 0.4%, kind of a 1 to 2 standard deviation move, the next hour they tended to come back. And actually, again, we continue to see, I'll just zero in on Aussie because the CAD has been a little bit mixed, but that Australian dollar seems to be the most mean reverting of these pairs that we look at every time we do a study like this.
Yeah, and the flip side of that is this dollar yen not cooperating with any mean reverting strategies using this criteria in the past year. That one to stay away if
or one to jump on if you're following trends.
Exactly.
Yeah.
So this is how I broke it down by magnitude. Also wanted to take a look at trade timing because these moves come in when we're thinking about the context of U.S. economic data releases. That is early in the U.S. trading period.
Sure.
And so U.S. traders perhaps able to monitor these positions better throughout a whole day. Is that worth it? Here are all your numbers that you like so much. And we took 1 hour, 2 hour, 3 hour, 4 hour, and 8 hours. So a whole accounting for the whole U.S. session approximately. And here we aggregated those hourly moves. So not as granular with the magnitudes, but any hourly move that was above that first threshold of 0.2%. And this is for fading the move. So this is a contrarian strategy. And we see, some validation from the chart before, and not a lot of, indication that timing is that important to me. Just seeing, green across the board for certain pairs. But what you couldn't see in the chart before is here, using this criteria, U.S. dollar, Canadian dollar appearing the most profitable consistently when fading the move.
Yeah, that is interesting. Okay, a couple of things, because everybody who's looking at this, their eyes are glazing over by how many numbers there are, which is not necessarily a bug. Could be, a positive for everyone, because as you digest this, I will try to talk through it, reiterating what Glenn said. This is accounting for all of the essentially large hourly moves over the last year in each of these markets. And now we're particularly looking at, okay, if you faded that move, or essentially like what were the chances of the move reversing that big 1 hourly move in the next hour, in the next 2 hours, in the next 3 hours, just coming back versus continuing in that direction. The most interesting thing to me here is, of course, one, the majority of these markets, you're seeing more green than not, which is to say that in any of these time frames, in any of these markets, on average, the move has tended to be reversed at least a little bit, then it has tended to continue in kind of a lightning strikes twice kind of scenario. Right. Now, of course, dollar yen, you see that market loves lightning. Lightning strikes for hours and hours and hours. And even that Kiwi, I'm surprised by as a commodity currency, that market hasn't mean reverted as much as its Australian and Canadian friends. But the most interesting thing to me here, Glenn, is you have, without even knowing it, confirmed that Losers Club is a very real thing. Because if you look at that 3 to 4 hour stretch there, these odds of the market reversing don't increase for pretty much any of these markets past that 4 hour. You could see for Eurodollar, the peak time for that market to reverse is the next 2 hours after a big hourly move. Pound, the peak is the next hour. CAD, the peak is the next 3 hours. Australia, the peak is 4 hours, but 2 hours and 4 hours, pretty much the same number there.
Right.
And on down the line, there is no market here that tells you the longer I hold this thing, the greater chance I have of reversing this move. And so helpful data in the fact that, okay, I mean, 5 out of 7 of these markets tends to reverse a big hourly move than to continue in it. Now, of course, again, That doesn't mean that, oh, I'm just going to do this blindly every single time with all these different markets and I'm always going to make money. Of course not. We're talking about, small pieces of edge in a relatively binary market. But again, what's super interesting to me, you have a CPI, you have a non-farm, you have an FOMC. That's obviously more of a middle of the day kind of number. Or you have, Trump tariff talks coming out of nowhere, whatever's happening, because this is obviously just filtering for big hourly moves in the last year. The greatest period for trading that back and forth, it looks like, is in the 1 to 3 hour range. If you're holding on to a trade from 8:30 Eastern time when CPI went off and it's 2 in the afternoon and you're like, well, I'm just going to hold this overnight because I didn't get the reversion I wanted and I hope I'm going to get it in the next several hours. Right here, not showing you that your chances are increasing as time passes.
Great call out. I think that is the takeaway here as well. That time not necessarily in your favor past that initial move. And then lastly, just want to cover the inverse of that, following the trend across the same time periods. And here you're really only seeing, dollar yen consistently outperform. And the edge there, not as great as the contrarian strategy for something like dollar CAD. But yeah, this would be the call out to me. Trending market, and New Zealand dollar can't really make heads or tails of it. Yeah,
that's definitely the toughest one. But what is interesting is we're talking about the FX market, okay? And you can speak more to it on the tastyfx in particular offering, but most providers in the U.S., the friction to trading is so little that whenever you see some, smart guy tell you about how if you're paying this commission and you're paying this spread and you're paying this whatever for, your margin, you're paying this interest on your margin, all this different stuff, then you need to have a win rate of like 55%.
Sure.
Or something like that. In here, and we can do you can run the same numbers and it'll be a pretty short and straightforward study. It's going to be less than 1% of friction when you're talking about these major pairs not paying a commission, paying the spread, and getting that trade on and off within an hour, not paying any kind of long-term margin or whatever. Although, of course, you can have the carry trade in your favor, so you can be getting paid. But anyways, I say all of this because if you did want to follow the trend in dollar yen, having a 53.5% win rate, as long as you are closing your losers for the same amount that you're closing your winners, you have some kind of symmetrical win-loss, you're going to be able to theoretically operate in a profitable area. Now, of course, again, that's taking a lot of assumptions there, which is you're going to be able to get the same profits as your losses. And a lot of emotions go into that. How much opportunity is there in that? Right. But yeah, especially when you're showing the dollar CAD stats and the Aussie stats and the Euro stats, and they're seeing some fading the trend, some contrarian win rates of 54, 55, 56, even up to 59% there for fading dollar CAD moves. You're talking about in such a low friction market, being able to engineer some theoretical profitable strategies for sure, as long as, again, you don't let those losers become 2-3x and you're able to get decent average profits.
Exactly. So covering just our key takeaways here, contrarian strategies, using this entry criteria, contrarian strategies have the edge when reacting to these major hourly moves when trying to take these positions off intraday in most pairs. Dollar yen the exception, consistently favoring momentum trades. USD CAD, Canadian dollar, posting the highest win rates for fading a move of greater than 0.2%, and showing that timing the trade less important, but importantly, that holding on to trades from 4 hours to 8 hours doesn't give you any extra edge using this data.